Good afternoon, folks. Welcome to the Heritage Wealth Planning video podcast. Today we're going to share with you how debt can ruin you financially. And it's the first chapter of my book that you can see here, Strategic Money Planning. And the chapter title is called Debt is the Enemy. And what we're going to talk about again is how debt can ruin you. And I find that a lot of people focus on financial planning, which is great, the big picture, but they overlook the small things. And the number one thing I've seen in my 20 plus years of experience is how debt can really cause you to have chains on when it comes to things you want to do in your life financially. So we're going to talk about a little bit of what happened to me as I was building a financial planning business in the mid-2000s. And then I'm going to go over a case study of a couple and the ways they were thrown through a loop because of the debt they carried. My book is going to be available. You can go on Amazon. You can order directly through me if you like. Strategic Money Planning, 8 Ways to Get Your Financial House in Order. I hope that you get a lot out of that. But I am just going to go over each and every chapter on this YouTube video post here as well. So I'll start with a little bit of chapter 1 today and just progress through it as we go on each and every day. So be on the lookout for other books I have as well coming out. My next one's called 21 Reasons You Should Have a Roth IRA. I'm excited to get that one published, but that won't be out for about another 6 weeks or so. So, all right, so let's go what happens here with this book, Strategic Money Planning. Let me give you a little bit of background about me. I was a financial advisor working for a big brokerage firm called Smith Barney back in the mid-2000s. I was building up a book of business, and because I was fee-based, that meant the bulk of my income came from the fees I was charging on the assets that my clients had with me and trusted with me, which is great when the markets are going up and up and up, because that means my income's going up and up and up as well, which was fantastic. But if you remember, October 2007 came along, and we just did this significant drop-off where the markets took about a 50% cut. So if my income base is predominantly built on the assets I manage, and those assets drop by half, it doesn't take a rocket scientist to figure out what happens to my income. So having 4 kids, and my wife was raising 2 brand new babies, so we had a family of 6 with just my income that declined by 50%. The irony is that my debt did not decline by 50% to go with it. So the lesson I learned there, and I should have learned earlier, but I didn't, it is what it is. You learn as you go, is that your debt is fixed, but your income is variable. So your income goes back and forth, but your debt stays the same. If your income is up here, guess what happens to your debt? It has this tendency to go up to match your income. If your income is down here, guess what happens to your debt? It does not drop to match your income. It's amazing how that works. So your debt is here, your income goes up here, and you're thinking, oh, I'm in pretty good shape. And next thing you know, your debt starts rising and rising and rising. So for us, the income is dropping like a brick in water. Our debt was still up here, and we had to make a pretty fundamental change. So I had to change jobs, and I found a firm in South Texas and San Antonio, which is willing to bring me on for a pretty good stable salary, wonderful benefits. The only drawback was I had to move from Virginia down to Texas. And I tell you though, when we went down to Texas and looked at the real estate, man, it was amazing. It was like sticker shock in reverse. These beautiful houses for cheap relative to what we're paying in Virginia, and I couldn't believe it. So we had this 3,300 square foot house, tiles throughout, backed up against some undeveloped ranch land. Oh man, just a wonderful place in the hill country. Loved it. And we only paid about 25% more than what our house was back in Virginia. So it was about 25% increase in mortgage payments for about a house almost 3 times as large. It was pretty sweet. And don't forget, in Texas, there's no state income tax either. So we felt we were pretty good to go. And so we increased our debt to meet our higher income. So our debt went up as our income went up. The problem was I get to Texas in my new job, and I didn't have much to do. I was floundering. Not that I didn't know what I was doing. It's just there wasn't much going on. We were in the middle of a financial crisis like we hadn't seen since the 1930s. And I tell you, a lot of people were not doing much in terms of financial planning. certainly weren't paying for fees for financial planning advice because they were lucky just to hold on to their jobs. So I was worried. I was like, this place is going to let me go because I'm not doing anything. And I've always worried about the LIFO concept, last in, first out, which means the new hires are usually the first to go. Even at non-union place, that's typically the place too. If you're a new hire, generally speaking, you don't have as much experience at the firm. So if they need to let people go, they'll usually let the least senior people go. And I thought that was going to happen to me. So I was worried because we had all this debt. When we were in Virginia, we had all this debt. We added some. Now, I did have a nice salary to accommodate that debt, but what happens if the salary changed? What happens if the income dropped? What if I got laid off? What if? These are all the questions that a good financial planner should be asking, frankly. So I was nervous for that first year. I was like, what happens? We had all kinds of, my wife, we had an old Dodge Caravan minivan that needed replaced. I'll never forget our first week or second week there. She was in a mall in South San Antonio, a rough side of town, and the car wouldn't turn over when she come out of the mall. 110 degrees or whatever. 4 little kids, and she couldn't get the car to start. Thankfully, it was just a battery and not an alternator or anything like that. But it made we needed to get a new vehicle, and that was pretty scary. So a lot of going on in terms of the financial situation that was requiring us to have income, which we just didn't have. So it's a big learning experience for there is to realize that your debt is fixed, your income is variable. Thankfully, it worked out for us. I stayed at that firm for going on 10 years, and it was a wonderful place. I did quite well, and it all worked out. But man, for that first year, I was scared. I was scared that I was going to be laid off, and I was scared that my neighbors would know. They say, oh, that guy doesn't have a job, and frankly, I was scared of what would happen if that were to happen. And it didn't happen, thankfully, but that was a concern of mine. I don't want that to be you. So what I want to talk about here today is you got to be careful on the amount of debt that you take, even if you think you can afford it today. What if something happens? What if something changes where in the future you can't afford it because you got laid off, you had to take a pay cut, your expenses. I'm going to bring up Brenda and Kevin, and this is directly from my book, first chapter, Debt is the Enemy. And I'm going to share you with a case study that has some similarities to what happened to us. Not quite as bad as what will happen here to Brenda and Kevin, but certainly something that you need to be wary of as you're considering taking on debt to meet the income that you have. Not the income to meet your debt, but a lot of people increase their debt because their income has gone above what their debt levels are, and they feel they can afford it. And just remember, you might be able to afford it today, but will you be able to afford it if something goes wrong in your financial situation? So here's the first table of my book, and what you can see here is in 2007, we see Brenda and Kevin have an income of $50,000. Now the premise, and I talk about my book here, is that Brenda is working full-time, making $50,000 a year. Kevin is in school getting his master's degree, so he has no income coming in. And so this is just based on Brenda's employment, and the idea would be that once Kevin graduates from school, he'll be able to get a job and maybe get another $35,000 to $50,000 a year job to double his income. And that's the premise that we're starting here with Brenda and Kevin in terms of their ability to pay off this debt that they have. So as you can see here, they have debt of $200,000 and they have income of $50,000. All right. Now their debt payments, their mortgage, their car loan, their student loans, all that, their debt payments is $24,000. So their debt payments divided into their income makes them have a debt to income ratio of 48%, which is high, but it's not extraordinarily high, relatively speaking. A lot of people have DTIs much higher than that. We'd love for you to have zero debt to income, but if you can get below 25%, you're in pretty good shape. As a point of reference, no bank or very few banks will loan you money for a mortgage if your debt to income is above 48%. Okay, so just keep that in the back of your mind. Debt to income ideally is below 25%. Now again, how you figure it out is you just take the amount of debt payments that you have and divide that into your income, and that gives you your debt to income ratio. Anything above 36, you're not getting a mortgage. I guess in some circumstances you can, but generally speaking, that's not going to happen. All right, so $50,000 coming in, their $25,000 is living expenses. That's to pump the car with gas, put food on the table, new clothes, dry cleaning, the whole thing. And so you add their living expenses plus their debt payments, and that gives them a $49,000 total debt. So they got $50,000 coming in, $49,000 coming out. Again, this is before taxes, so just don't sweat that for now. But generally speaking, we'd adjust for taxes here as well. What I've done is I've assumed taxes coming out of living expenses, but we could have made a different line item, and I do that in other parts of the book. But anyway, $50,000 coming in, $49,000 going out. That means they have a surplus of $1,000. All right, so they have $1,000 more coming in than going out. Now, they're not saving anything because that $1,000, they don't know where it goes. No one does. If you look at people's budgeting, myself included, no one knows where every single penny goes. I mean, I imagine there are some people, but I've been doing this for a long time. The vast majority of people don't. So essentially, they're breaking even here. They're not putting anything away, but they're not taking on debt either. So while it's not perfect, it's not a bad place to be. Obviously, when Kevin gets out of school, we'd want to see their income increase so they're able to save some money and put some money away. But for the time being, they're getting by. However, 2008 comes around. You may or may not remember. I remember like it was yesterday. People were getting laid off like crazy. Brenda goes in the office. Her boss says, "Brenda, I'm sorry to say, but we got to make cutbacks. The ship is just taking on water, and we just got to make cutbacks to keep things basically from capsizing and sinking. And so what we're going to do is we're going to ask the executives to take a 33% pay cut, and the non-executives like yourself to take a 20% pay cut. Now, while it's a shared sacrifice, and we're all sacrificing to some degree, we know it's hard, but we're just asking everybody to do that until we can get the ship righted and move on to greener pastures. Because if we don't do it, we might not be able to stay in business, and we'll all be without work." Now, Brenda is grateful to have a job, mind you. She knows a lot of people have been laid off in 2008, but let's look at the spreadsheet here. To have a 20% income reduction drops her income from $50,000 to $40,000. Her living expenses stay the same. Now, living expenses is an area that she could adjust, her and Kevin. Maybe cut back on steaks, cut back on eating out, things of that nature. But a lot of times it's not as easy as you think. If you can find some fat in your budget, more power to you to cut that out. But the problem is that $40,000, she still has to carry $24,000 of debt payments. Her debt payments haven't gone down, and her debt payments won't go down. All right, so her debt payments are fixed. The income is variable. And again, now when we take our debt payments, divide into our income, her debt to income ratio, hers and Kevin, is 60% now, which is starting to get a little bit scary. Because that means that they have total deficits. They're spending $49,000 a year, but they only have $40,000 in income, which means they're in the hole this year by $9,000. There's only one way to fill that gap, is to borrow more. And so let's go on to 2009. Because they had to borrow that $9,000, let's get the little, here we go. Because they had to borrow this, that is added to that right there. All right, so now $9,000 goes into $200,000 they had before, so their total debt is $209,000. Income is still $40,000, so their income is still only $40,000. Let's see, there we go. So the income hasn't changed. They weren't able to cut anything from their budget, so their living expenses are still $25,000. But now, because their debt is $209,000, their debt payments are $25,000 as opposed to $24,000. Take this $25,000 into $40,000, and that gives them a DTI of 62.7%. 62.7% with a total expenses of $50,000. You have $50,000 expenses, you got $40,000 income, and your deficit now is a serious $10,000 deficit. Folks, it's not going to take long before that right there bankruptcy, because no bank is going to loan you money when you're borrowing each and every year $10,000. It's just not going to happen. No bank's going to allow that to happen. You're going to have to either go bankrupt. That's what I want. You have to, because you have to increase your income, reduce your debt, or go bankrupt. There's nothing else you can do. One of those three things is all you can do. You simply cannot keep taking on this amount of deficits and have a bank loan you money. Remember, I told you a bank won't even loan you for a mortgage if your debt to income is above $36,000. Well, here, their debt to income's it's almost twice that, 62, 63%. It's increasing every year. No bank is going to take that risk. There's no collateral behind your debt at all. You're a step away from going bankrupt. And that's the moral of the story. Just because you can afford it now, right? Again, look, they're in 2007, they weren't doing great, but they were getting by. But what happens if something goes awry and now your income drops off? Your debt is still the same. At some point, you're going to have to make a decision on how to get by. Don't let this be you. Be very, very, very careful of the debt you take on. My next video here, I'm going to talk about leverage, because a lot of people assume leverage is a wonderful tool to build wealth, and I completely disagree with that. I'll talk about that next. But again, leverage and debt go hand in hand. And a lot of people assume that just because they can afford it today, they'll be able to afford it in the future. And I just caution you on that. I'm not saying you can't. Because in this case, if Kevin were to get a job, they would have more than $50,000 a year in income. And as long as they didn't increase their debt payments, they'd be fine. But given what happened to me and my family, I guarantee you know people it's happened to. Maybe it's even you. Just be careful. All right, so let's close up this. The only thing I want to ask you guys is comment. I'd love to hear your comments on it. Comments actually help me build this channel. Did you have an experience of 2008 and the Great Recession? Were you able to, how did you manipulate it? Did it affect you at all? What did you do to avoid being affected? What did you do if you were caught in that? I'd love to hear it. So put in the comments below, would you please? What lessons did you learn from 2008? You know, the issue is I'm a professional financial advisor. You might not be, but I certainly believe you can learn from me and I can learn from you because you have experiences that I don't have, that other people watching this channel might be able to learn from. So share, please. How did 2008 affect you, and what experiences would you share with somebody who's coming up that you can teach them to say, oh man, do this or don't do that? Hit subscribe down below. That red button, the subscribe button, just says you're signed up to the channel. But until you hit the bell for notification, you won't be notified that there's new content out there. So hit that bell and you'll get notified via email, and every time you log into YouTube, you'll see a notification on there too, okay? Appreciate it. Keep looking out for more videos, guys. Comments are always welcome, and stay tuned for more. Thanks.